In income statement analysis, we use similar techniques as in the case of the balance statement analysis. So first technique that we use, we simplify the income statement. Afterwards, we create the comparative income statement and then use different methods and tools to analyze it. So first stage is simplification of income statement. As we already know from the accounting, the income statement is a large document with a big breakdown of revenues, costs, and income. So in order to be able to understand the essence of the income situation of the company, what we need to do is to simplify it. So we can get the income statement for different years, different previous years. What we will do is we will simplify and make it simple. So the income statement, simplified income statement, will look like this. In the major dimensions, we'll have revenues, expenses, and net income of the company. So we will also break down the revenues from main activity and also revenues from other non-operating activities, and also the costs of the company will be broken down as costs on main activity and costs on non-operating activity of the business. And finally, we will have the net income figure in the analysis. So when we have that simple income statement, we will go forward and create comparative income statement. In comparative income statement, we will use this big table structure to organize it. And what we want to see the structure and the growth or decline of main items of income statement. So basically we will transfer the information, the numerical data from the simple financial statements to this table, and we will put the information about revenues, costs, and income in the first year column, in the second year column, in the third, fourth, and fifth year column. And then using formulas, we will be able to calculate the structure of revenue, structure of expenses, and structure of income in percentages. So for each year we will have the structure of each item. And also at the end of the table you can see the last four columns. So in those columns we can use again formulas to calculate the growth or decline of revenues, costs, and also the income, and this will show us the current situation of the company. Every analyst during the analysis wants to see if company is able to maximize revenues, if company is doing efforts to minimize, to cut the costs, and at the end, the final interest during the analysis of income statement, we want to see if income or profit of the company is growing or not. So this is a very good tool to see the trend of those changes in 5-year period. After we create this comparative income statement and have it in front of us, the next step is the analysis. So we can use the pie chart to analyze the structure of revenues, structure of costs, and structure of income. We also can use other kind of charts to understand the increase or decrease of revenues. So for example, in case of the structure of revenues, costs, or income, we can use the pie chart to show visually the percentage structure of revenues and break it down: revenues from financial activity, revenues from investment activity, revenues for other non-operating activity, and the revenues from main activity. So at the same logic, we can break down and show in a pie chart the structure of costs and also the structure of income, and also we can break down the costs on main activity and demonstrate it in those pie charts. And in case if we want to observe the increase or decrease trends of revenues, costs, and incomes, we can use this kind of chart. So in this chart, investors, financial managers, and analysts can see the main information that they want to understand from the income statement. So bottom line, when we are analyzing financial statements, the key numbers to look for in determining the financial health of the company are the earning power of company, so company's revenues and cost trends over some number of years, also the asset value, and also the structure of liabilities. So in balance statement analysis, we want to understand if company is under debt or not, what part of their assets are current and non-current, and what is the value of those assets. And we want to see the equity per share. In case of the analysis of income statement, we want to detect the earning power. We want to see the past revenues, the past costs, and their difference, which will be the income. And based on that, we can make some conclusions. So this quantitative data should be accompanied with the results of qualitative analysis. Without qualitative analysis, we can't make investment or financial management decisions. So for example, with that quantitative information, we can use the competitive advantage of the company and industry, or the efficiency of the managers, or the long-term growth outlook of the business, and some other tools that are also useful. Thank you for your attention, and see you next time.